To make it in investing and business. To make millions and billions in business and investing, you must understand the makings and the psychology of those doing it already. Millionaires and billionaires always say you need a mentor, whether direct or indirect, to become a millionaire or a billionaire. Hello everyone. Welcome to AB Food Fitness Finance and Fun. In our last video, we enjoyed the mastermind and mentorship of a goddess investor, entrepreneur and billionaire Cathie Wood. In today's video we take another mentorship series from another investor and billionaire, Peter Lynch. But first, to better grasp the inspiration that Peter exudes, let's have some insights into his beginning, so we can copy and model on his life. Because Peter as an investor operates on a different level. Peter Lynch is an investment giant who during his 13 years as head at Fidelity Magellan, from 1977 till 1990, managed to realize annual returns of 29%. When he first took over, the firm only had $20 million as assets, but Lynch was successful in increasing it to $14 billion in 13 years. During his time in charge of the firm, they effectively outperformed the S&P 500 index every year, except for 2 years. Peter S. Lynch was born in 1944 in Boston, Massachusetts, United States. His father was Thomas Lynch. In 1951, when Lynch was 7, his father was diagnosed with cancer. He died 3 years later, and Lynch's mother had to work to support the family. After the death of his father, the condition of his family was not good. So to support her mother in earning for the family, he started working as a caddy in some golf club. Working as a caddy proved to be of great significance in his life, as his interest in the stock market developed by overhearing the conversations of great investors who came to play golf there. His first investment was in the air cargo industry. Later on, when he was pursuing his graduation from Boston College, he used to save money. Out of the saved money, he purchased 100 shares of Flying Tiger Airlines. Since this stock was rising at a high pace in the market, it gave high returns to him. Peter used those returns to pay the fees of his college. He completed his graduation in the year of 1965. He also completed his master's in business administration from the University of Pennsylvania in 1968. From Fidelity intern to Fidelity fund manager. Before the launch of his career, Lynch was a caddy to the president of Magellan along with other investment bankers at the Brea Burn Country Club. After befriending the president, he was provided the opportunity to intern at Fidelity Magellan in 1966. After he completed his graduation in 1966, he was hired as an intern at Fidelity Investments. He also went to serve in the Army for a period of 2 years from 1967 to 1969. Later, when he came, he was hired at a full-time job in Fidelity at a post of textiles and metals investment analyst. He also got a promotion to the post director of research in 1974. After serving for 3 years as director of research, finally, he was made the fund manager of Magellan Fund in 1977. This fund mostly held domestic investments. The day Peter took over this fund, it was having total investments of $18 million, and 13 years later, when Peter resigned from that post and company, the fund held investments of approximately $14 billion. This is the 13 years of his career where he averaged an annual return of 29.2%, which is marked in the history of mutual funds. As the head of Fidelity Magellan, Peter Lynch worked assiduously, working 6 to 7 days a week. With the help of 2 assistant researchers, he was capable of investing in as many as 1,400 stocks at one time. He himself used to personally meet with various brokers, company managers and analysts to acquire first-hand knowledge regarding the financial market. His hard work and ambition paid off with historical growth in company assets and annual return of 29.2% during his 13 years. He retired at the age of 46. Investment philosophy of Peter Lynch. The most important philosophy, as per Peter Lynch, is, invest in what you know. It is a fact that everyone has good knowledge of their own work, and they can easily understand the financial and non-financial performance of companies involved in business related to their work. So, he advised many people that investment should be made in those sectors in which you are regularly engrossed. Also, he suggested investing in companies which are manufacturing or retailing the products we use in our day-to-day life. He also believes in investing for the long term. Peter Lynch believes the price-earnings ratio is not enough to judge the growth of any company. Though it is a myth in the market that companies with lower price-earnings ratios are right for investing, He believed the fact that only this factor does not define the true picture of the firm. So he formulated a price-to-earnings-to-growth ratio. This is a basic formula that divides the price-earnings ratio of the company with the growth rate of the firm. According to him, those companies which were having a lower growth rate than their price-earnings ratio were undervalued in the market and vice versa. He started exploring in these undervalued companies and invested in them. Till the company remained in its growth phase, the money was kept invested by him in them. Once they reached their apex, he sold the shares and invested in other growing companies. The price-to-earnings-to-growth ratio is also used by the modern fund managers to determine a firm's growth potential and price of that company based on the growth. Peter Lynch firmly believed that individual investors had advantages over professionals when it came to research, because unlike the latter, individuals had more freedom to act independently and explore the market without being tied down by committees, trustees and superiors. According to Lynch, this flexibility to act gives small investors an edge as they have a better ability and potential of discovering profitable investments. He encourages the adoption of the bottom-up approach to discover good investment opportunities. He suggests digging up possible investment options one by one, then getting familiar with the company business and lastly conducting the fundamental analysis to verify growth and profitability potential. Local knowledge is what Lynch preached and claimed as the key element to successful investment. His well-known investment principle of "invest in what you know" is still deemed as being one of the most essential lessons for any serious investor. What he adopted was a story approach to investment. He believed the more one knew about the company, its business, its products, and its competitors, the more chances there were of finding a good story which had high possibilities of coming true. Additionally, he also considered small or emerging companies as good investments as they have higher growth prospects than more mature companies. However, Lynch stressed strongly that having a good company is not enough. You have to research the fundamentals, and look at the valuation. He presented 6 types of possible stories for companies. They include the slow growers, stalwarts, fast growers, cyclicals, turnarounds and asset opportunities. Slow growth companies are the least preferred among the 6, stalwarts serve as good protection, fast growers come with considerable risks, cyclicals are highly depending on timing, turnarounds do not perform in accordance with the market trends and therefore require substantial research, and lastly, asset opportunities are the most preferred out of all the above-mentioned company stories, as they are concerned with the profitable assets which the Wall Street analysts have overlooked. Having a proper understanding of a business and their assets can prove to be the most profitable. He believes in investing on a long-term basis, ignoring the short-run market fluctuations. To him, it was important to stay fully invested and not hold cash. As the head manager at Fidelity, he focused on investing in stocks which promised above-average profit opportunities. There are 3 essential qualities that Lynch looked at, which included profitability, price and good business model. According to Lynch, attractive companies which have been proven to have high growth and profitability prospects and have a P/E ratio below the industry average, and below the company's historical average. Furthermore, the company should preferably have a steadily growing dividend over the span of 20 to 30 years. The company debt should be low, and the net cash to share price ratio should be high. On a more general note, spin-offs, fast-growing companies in no-growth industry, companies producing goods with inelastic demand, companies with limited analyst coverage, low institutional share in the company, and companies with insider buying, are all potentially attractive. Peter Lynch is also famous for his introduction of the PEG. PEG is a ratio which determines if the stock is cheap, while keeping in consideration the growth of the stock. The PEG is determined by dividing the company's P/E ratio by the historical growth rate. According to Lynch, the faster the company is growing, the higher the P/E ratio you should be willing to pay for its stock. Additionally, Lynch advised against diversification of portfolio if it reduces the ability of the individual to efficiently research on and analyze the existing stocks. Even though he owned 1,400 stocks, they made up a small fraction of his portfolio. Lynch also mentioned that it is wise to sell the stocks of the companies once the story has played out as expected, or if it is not heading in the expected direction. Peter Lynch's simplified investing quotes. 1. Go for a business that any idiot can run, because sooner or later, any idiot is probably going to run it. 2. Investing without research is like playing stud poker and never looking at the cards. 3. If you spend more than 13 minutes analyzing economic and market forecasts, you've wasted 10 minutes. 4. Everyone has the brainpower to follow the stock market. If you made it through 5th grade math, you can do it. 5. The person that turns over the most rocks wins the game. And that's always been my philosophy. 6. You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready, you won't do well in the markets. 7. There are substantial rewards for adopting a regular routine of investing and following it no matter what, and additional rewards for buying more shares when most investors are scared into selling. 8. Investing is fun, exciting, and dangerous if you don't do any work. 9. Never invest in any idea you can't illustrate with a crayon. Now, you have an insight into the life of this uncommon investor and business giant. Think deeply, and decide how to stand on his shoulders to become a millionaire or a billionaire by investing and in business. Thanks for watching. Don't forget to like the video and subscribe if you haven't.